What if I told you the real difference between rich and poor is not how much money you make, but it's how you think about money? In this video, I'm going to give you the 5 things that the rich do differently that made me change exactly how I manage my own money forever. Number 1, I focus on building income producing assets. So here's the reality of it. You are either self-made rich or you are self-made poor. Those are the 2 options that you have. What that means is either you are the asset that actually goes to work every day and makes money from a W-2 paying job with a real paycheck that you collect from an employer, or you take the asset producing route. Or option 1, you are the asset where all the money flows through you based on time, work, and how often you show up. Or you buy assets that literally do the same thing that you would be doing. So what you're trying to do is you're trying to buy real estate that produces income, or businesses that produce income, or anything that produces income. In other words, it's not you, it's something else producing the income for you. They're literally income producing assets instead of you. What most people don't understand is that they are the income producing asset and all the money flows through them. But they're literally the vehicle for the employer that they work for that produces an income producing asset. So for example, say I want to buy a new car. Let's say a Lamborghini, for example. What I always do is I say, what asset can I buy that produces the income to pay for that Lamborghini? Whereas most people just buy a Lamborghini out of the money that they saved for who knows how long. I would rather take that saved amount and then have that income producing asset pay for the Lamborghini. So it's a big difference in the way you think. Most people save their money and then go buy assets that depreciate, like the Lamborghini. I save my money and go buy assets that appreciate and also kick off passive income every month to pay for whatever it is that I want. That could be cars, it could be houses, it could be vacations. It doesn't really matter, whatever your heart desires. There's a very big difference between the rich, the poor, and the middle class. The middle class saves money, then buys assets that depreciate. The poor generally live from paycheck to paycheck and buy depreciating assets. The middle class generally invests in the stock market through a wealth manager or a financial planner that they trust. They then save money for things like vacations and things like that. The rich take that same money and invest it into assets that produce passive income to pay for whatever they want. The second one is how you use debt to acquire wealth. So what does that mean? So first off, all the debt is other people's money. So as people put their money into a bank, it becomes a liability for the bank. And then the bank lends it to rich people like myself. That's exactly how I grew my portfolio to over 1,000 apartments. And we currently have a couple $100 million in debt that's paid for by over 1,000 tenants. So all my tenants currently pay for the mortgage payments on over $200 million in debt. Once you understand that all money is debt, and then all you have to do is fix the interest rate to hedge inflation and then have other people pay it off, you can get exponentially wealthier with this strategy. What most people do is they save a bunch of money, then they pay cash, or they use high interest debt that's floating, variable. Poor people generally spend, then try to save. Rich people generally save and then look to spend. But the money that they save, they invest first into cash producing assets. So poor people have bad habits, like using credit cards at over 20% interest that they can barely keep up on or pay off. They typically finance things like vacations and fun and clothes on credit cards. They never ever get out of debt. That's what we consider bad debt. Good debt is debt that you use from a bank or from a life company or from a pension company to invest in an asset that somebody else pays off. That's the biggest thing poor people get into is debt. They pay things off. Good people get into debt and other people pay them off for them. In addition to that, they produce cash producing assets. The third biggest one is around tax. Now, tax will be and always will be the number one expense of your life. Most people work until about April or May every year to pay tax, and then only the remaining part of that year is actually money going to them. Most people are paying 30 to 40%, even sometimes higher in taxes when you add everything up. So the number one skill for every business owner and every person is to understand how you can minimize legally the amount of tax that you pay each day, each month, each year. That's the number one thing that you need to understand. Everyone can do this. So the main reason why I don't pay hardly any tax at all is because I buy real estate. So the government gives me tax incentives and tax advantages for actually building and owning rental housing for people. They give me things like bonus depreciation, cost segregation, or straight line depreciation. Those are things that I get to offset some of my income. I'll give you one great example. Say I buy a billboard in the sky for $1 million, and I can finance $700,000 or $800,000 of it, and put $100,000 or $200,000 down of somebody else's money, of course. I can then get a tax break for almost the entire purchase price to offset income. That's called bonus depreciation. You can do the same thing with farm equipment or even a private jet if you like. So there are things that the rich do to offset tax, and they will always do this. The fourth one is to understand how the legal process works. There's a lot of litigious people out there, and they always want to sue, especially these days. People are looking for any reason at all to sue you. So the best thing that you can do is not hold anything in your name to protect everything you own, and the rich do this each and every time they buy an asset. So they buy an asset, they put it inside an LLC or a limited liability company. If they get sued, the lawyer has to sue the LLC or the company. In other words, instead of suing the person, they're suing the company. That's a big difference. And then the lawyer has to pierce that corporate veil to get the assets inside of the company. If you as an individual own lots of different assets in your personal name and you get sued, then that lawyer has access to all of those things. Not good. If you put a lot of your individual assets into multiple LLCs, as you should, then you have a diversified asset strategy that's going to help you in the case you get sued at some point. In addition to that, there's even more complex structures like revocable trust, where you can actually put your assets into other vehicles that grow tax deferred or tax free over a long period of time. So that's when you hear the term trust kid or trust fund baby. That's exactly where that comes from. That's another form of asset protection. The fifth one is how people manage their money. So the poor basically lives paycheck to paycheck, right? We've clarified that. They of course spend, then invest if they can. They do it backwards. They're typically somewhat bootstrapped. They're the ones most at risk to things like gas prices, inflation, rent growth, and all that kind of stuff. The second category is the middle class. Now, the middle class has been brainwashed to go to work, get a paycheck, and carve out part of that paycheck and hand it over to a financial planner or a wealth manager that manages money for you. The problem with that is that you look every quarter to see if your statement has gone up or gone down, and you never know. You really have no idea exactly how that's being managed. And maybe if you're lucky, once a year, your financial planner might reach out to you for 30 to 45 minutes just to recommend more products to you, which of course they get fees to put you in. Generally, that's how the middle class invest. So the middle class is they work a lot more to get ahead. and they keep putting their money into things like retirement accounts and 401k plans and stock market, all those kinds of things managed by these wealth managers. But they don't know why, and that's the biggest issue. There's nothing wrong with being part of the middle class, but if you don't know what to ask, then you are completely at the mercy of Wall Street, the fees, the commissions, all those things. Because you don't even really know where your money is. The rich take a really active role in the way they manage their money. In other words, when I'm coming out of a deal and I have lots of cash, I'm always looking at where I'm going to put it next. I'm always focused on what I call the velocity of money. I want money to keep moving. I never want it to sit in my bank account for a very long time. I do like liquidity. I do like safety. I do like all of those things. But as long as I have it in some vehicle where it's making money and beating inflation, which is the most important thing. So when inflation went up to over 9% not long ago, anybody that had stocks or bonds or savings, let's say, in the 2, 3, 4% range was actually going backwards financially. When inflation is higher than your rate of return, then you are going backwards. So that's why everybody was panicking. So the rich understand this, and some people still are panicking today. So to recap, what the rich are trying to do is they're trying to buy cash flowing assets. That's number one. These assets produce tax benefits, but are also beating inflation. Also, don't forget these assets are being paid down by someone else. So in my case, I have tenants paying down my debt. So my loan balance is going down each and every month as my tenants pay me. They pay me, I pay my mortgage. Then my loan balance goes down each and every month. I'm beating inflation because I have a nice return above the inflation number from the actual investment itself. I'm getting tax advantages in the form of bonus depreciation, straight line depreciation, cost segregation, and those kinds of things. So the income I make, I'm actually able to offset as well with things like depreciation, which is a non-operational expense that you get for actually supplying housing. It's not that complicated. If I can learn how to do this, you can learn how to do this as well. I grew up poor, just like a lot of you, thinking that money would solve all my problems. The truth is, real wealth is not jets, cars, houses, or any of that stuff, which is exactly what I thought it was when I didn't have any money. True success starts inside. It starts with you understanding how the game is played, because the game is not changing. Don't be a participant or sit on the sideline. Moral of this video, buy income producing assets first that pay you forever, not depreciating assets that you have to continue paying for with your personal time. That's real wealth. Till next time.